Hey guys, I hope you are doing great. Back to this channel, and so we had a very dull week, I guess. Yeah, there was no movement in cash and futures in index also for a better trend. So yeah, today I'm with one learning video for trading, and today I'll talk about the moving average and which moving average you should be focusing on if you are trading for swing trading. And I'll also share what most of the big hedge fund managers or investors have been using that over a period of time. I also know few people who only trade using a single moving average, and they just go long when the prices go above that, and they've been making money. So that's their style of trading. But today I will talk about which moving average are very important for trading in a trend, to capture a bigger trend to make returns in the markets. So yeah, so the moving average which I'm talking is none other than 200-day moving average and the 10-week moving average. Now we all know that 200-day moving average is considered very strong, and if a price goes below this level, then you don't go long. So this moving average was made popular by one of the finest trader, which I admire a lot. That's Paul Tudor Jones. He had anticipated a crash which happened in 1987 by just when the price went below 200-day moving average, and he had shorted a lot and he made a lot of money. So I will share is one of the article. This is the article available on internet where he's talking about the trend following system, and he says over here that did your theory about the 200-day moving average alert to that one. So he was anticipating a crash, and he said yes. So what he means that if a stock falls below this level or line, then there are chances that the price might fall furthermore, and that is a not good sign if you're long in that stock. So that was this guy used to follow, and he has made huge amount of money by just following this simple aspect. And so this is the one moving average which I also follow. You'll always see this moving average on my trading chart most of the times if I'm doing swing trading or if I'm doing any kind of trades for that. The another one is made famous by William O'Neill. He has clearly mentioned about 10-week moving average in his book also, and his many of interviews also. He talks that when the prices move above 10-week moving average, then and when they form a cup or a base or a handle or a contraction, and when the price breaks out on a pivot, that's a good buy signal for that stock. Now 10-week moving average, basically, I how do I plot? I just convert that 10-week into 50-day moving average, because 10-week is nothing but 50-day basically on the charts. If you see 10, so every week has 7 days, so 70 days, but you have Saturdays and Sundays, so 10, 10 minus, so you'll get 50 as a number. So 50 is the moving average which you should follow if your time frame is on the daily chart. So now I'll share you on the charts. If you see, so I can clearly see this is nothing but euro and dollar forex chart. I do not trade forex, but I'll be starting with that soon. So you can see this is on the daily time frame. You see that the price made a low over here, and then when the price went, the blue line is the 200-day moving average, and the yellow line is the 50-day moving average. So when the price went below this level, the price corrected like anything. It was a under huge pressure of selling. Price almost fell from, it fell 20%. That is a huge amount in a forex markets. So yeah, you can see the price was falling beautifully. And another thing which you always need to see is the slope of the 200 moving average. If the slope is if the slope is slanting towards downside, then the stock is in under a lot of pressure. It is under a lot of good selling pressure. And secondly, you can see 50-day moving average. The price got rejection over here, second rejection, third rejection, fourth rejection, fifth rejection. So every time the price came to 50-day moving average, it bounced down. So that's the power of moving averages. So now the question arises: do I follow moving average or not in my trading? Answer is no. I do not take trades just from the moving average. The logic is too simple. If you see, So yeah, if you see price went below this level, so you would have shorted it. It went for like 1, 2, 3, 4, 5, 6, almost 10 days. It was trading below both the moving average. So why it was a short call, and you would have got trapped. So now what actually happens with the moving average and the price? So if you see, technically I would have actually bought this stock, because you can see there was a nice pattern formation on the downside, and this was a channel breakout, and I would have bought over here. I would have targeted myself this high, almost this high, and I would have made like 4 or 3% in this thing. So as a trader, you have to follow the price. So what happens basically, when the price moves downwards, the moving average gets attracted towards that. So if the price is halting, the moving average won't move that much speed. So when this move came, moving average started showing its sloping downwards. But so now if the price doesn't fall further, the moving average will stay there. So moving average, the price is the one which follows, which starts the movement earlier, and the moving average just confirms, and it just follows the path of the price. So if you follow this moving average, either you will be too late, and your risk reward won't be matching to the trade you are taking. So what I consider is follow the price. I have bought stocks below 200 moving average, and I've also shorted stocks above 200 moving average. So the key important is that you have to follow the price, and you just need a confirmation for the moving average. I'll show you one more example where you can see that how moving average gets stretched. So if you've seen Adani Enterprise, yes, I just omit the other drawing. So yeah, you can see over here. So when the price fell this much, the moving average was over here, right? So now the price went so deep that the moving average started sloping very nicely. See, you can see it went sloping. Basically, it started sloping over here. So that's very important. And if you see price is about the moving average, price is above this, you'll go along. But then what happened? So you always follow the price, not moving averages. But yeah, it is very important to know about moving average, especially 200-day moving average and a 50-day moving average, for looking at a bigger trend, or to capture a trend before it's to capture a proper trend for good profit and good trading. So yeah, thank you for watching the video. I hope you like the content. I'll keep on posting a lot of videos about trading hacks, about secrets about trading, and how trading should be. There are a lot of things which you can improve by just learning and through experience and gaining knowledge. So yeah, so do like the channel, subscribe to this channel, and do comment down if you have any doubts regarding any issues you have. So yeah, thank you for watching the video, and also don't forget to like to this video also. Thank you.